April closes out with new record highs for stocks alongside another set of good economic data. Will stocks be able to continue their climb despite the record earnings reports and indications of widespread inflation? Or will investors start to take a more conservative approach with a concern that this could be as good as it gets for a while? That action starts now. Cyclicals and value stocks took a leadership role for most of the month. The Dow Jones Industrial was up 2.48% and the S&P 500 gained 4.72%. The Nasdaq also picked up 4.09%. April saw a pretty big rotation out of large cap growth stocks and into cyclical and value stocks. This was definitely reflected in their overall performance. As we look ahead to May, the environment could get a bit tricky. Many stocks just posted some of their best, if not their all-time best quarterly earnings reports. While this is a good thing, it will most likely cause investors to pause and evaluate the sustainability of such growth for future earnings releases. Any miss on that guidance could have some serious implications for both the individual stocks as well as the overall market. April saw the 10-year yield retrace its quick uptick to 1.74%, back to a more modest 1.53% by the middle of the month. However, it has been slowly moving back towards that recent high and closed out the month at 1.63%. This is still a very important element that we need to keep a close eye on, as any sharp movement back to the recent highs or higher would most likely deliver a repeat sell-off like we saw at the end of March. Oil grind higher through the month, closing at $63.52. However, it has been drifting in a range between $60 and $67 since the second half of February. If the demand outlook continues to increase and COVID concerns continue to moderate, the odds of a breakout to the top side in the near future will become increasingly more likely. Copper added to its gains for the year, closing up 12.37% for the month. Further movement to the upside is expected as evidence of a broader economic recovery continues to gain momentum. Gold was able to break out of its February-March range-bound levels by gaining 3.13% in April. The precious metal did experience some choppiness at the end of the month in lieu of solid economic data and Biden's proposal to spend trillions more. Gold closed out the month at $1,765.70 an ounce. After several weeks of a dollar rally that took it to $93 at the end of March, the dollar nearly retraced all the way back to its value at the beginning of the year, closing out at $91.30. As long as the Fed continues its dovish rhetoric towards tapering and vaccinations continue to improve in the EU, it is expected the dollar will be range-bound in the $91 to $93 level. The FOMC continues to remain steadfast in their desire to keep interest rates low and QE in place at the current levels until there is some substantial further progress in economic growth in the labor market. What this means is inflation will continue to rise, as many of you are already seeing in the goods you are purchasing. As I mentioned earlier, President Biden announced he would be proposing another spending bill for approximately $4 trillion. His plan to pay for this includes a tax hike on capital gains for millionaires, crackdown on corporations, and wealthy individuals to pay their fair share of taxes and a gas tax. As I said last month, there is a tremendous amount of money that has been pumped into the economy within a relatively short period of time, and it appears there is an enormous amount more that is yet to come. There will definitely be a day of reckoning when we have to pay this all back. Historically, this is accomplished by using one or a combination of two options. They are inflation and taxes. Regardless of what the Fed is telling us, I would not be surprised if the bond market, which is very smart and very powerful, ends up forcing the hand of the Fed to start talking about tapering sooner than it wants to. Just look around. Inflation is already playing havoc in many areas of the economy, from corn and bean prices to land, boats, cars, housing, food, household goods, fuel. The list goes on and on and on. Additionally, the current administration is pushing to raise taxes on individuals, corporations, and investments. Folks, buckle up because we are just getting started. Whenever the Fed decides to disclose that it's time to start talking or take action to taper QE, I am confident that stocks will see some kind of negative reaction. To what extent? Well, we will soon find out. So, for the month of May, our models continue to hold a 30% cash allocation. Our broad focus remains on domestic and international equities. On the domestic front, our attention is still on small cap growth, small cap value, small cap blend, and mid cap growth. Our favored sectors are consumer cyclical, financials, energy, industrial, basic materials, and technology. As for international equities, our focus is on European developed and Asia Pacific developed. As a reminder, my current allocation is not a recommendation. Regardless of what happens next, investors like you need to have a simple and yet solid financial plan that reduces risks, costs, and taxes while securing the necessary income you need to maintain your lifestyle throughout retirement. So if you don't have a plan or you're just not comfortable with the plan that you have, call me today to get pointed in the right direction. I'm Chad Kuntz, and that puts a wrap on the May 2021 Market Action Report. Thanks for joining me. It's time for me to get back to the markets, and that action starts now.